Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us. As I record this today, the day after the sixth largest drop in the Dow in history, as well as the first trading day after Standard & Poor's downgraded the U.S. debt to AA plus from AAA, I have the opportunity to try to impart my thoughts and feelings on this situation to you. And I hope that you will not panic. The worst thing to do at a time like this is in fact panic. I'm not saying that you shouldn't look at your portfolio, make changes, may be warranted, they may not be warranted, but the key thing is not to panic, to make cool-headed decisions. And on that note, I had some research done late last night. I thought this might be useful, maybe not, but just for your information, I looked at the data from all the way back from 1929, the S&P 500, the Standard & Poor's 500, the 500 largest companies in the U.S., the market, and I looked at its performance after an 11-day, within 11 days when the market went down 15% or more, which is what we just had happen. So I look back in history. Number one, has this ever happened before? And it sure has. I've got here maybe 20 or 25 days or 20 or 25 other times where the market went down at least 15% in an 11-day time period. And so we look at those time periods, and what I would call that is panic selling. Whenever you have the market go down that much in that short of a time, it's panic selling. So we looked at the returns around panic selling, and we looked out what happened 63 days later and then 126 days later. And so that's essentially 63 days, about 2 months, and 126 days, about 4 months. And so we see that the average 63 days later, once again, this is after the market has gone down at least 15% in 11 days, we see the average return 2 months later was plus 4.7%. Okay, the average, of course, as you may or may not know, can be skewed by high or low numbers. So we also want to look at the median. The median is if you line up all of them in a row, plus 20 to negative 20, and you take the one in the middle. So the one in the middle was 3%. So once again, 2 months later, the average was 4.7 and the median was 3%. Now this encompasses quite a broad range, as I finished up last segment talking about this days and couple weeks demonstrate the sheer unpredictability of the market. But anyway, the returns range from, we see a minus 27.9% back in 1932. So the market went down 15% in 11 days, and then the next 63 days went down another 27.9%. I will tell you that that same time frame, 126 days later, the market was up 31.4%. Back in 1931, it went down 22 and then minus 38. So there's a lot of variability. Back in 1933, the market went up 54% after a decline. More recently, we look at just in 2009, March the 2nd of 2009. If you remember, the bottom of the market was March the right around that time, March the 2nd or 6th or something like that. Anyway, so in 2009, after going down 15% in 11 days, the market rebounded and was up 34% 63 days later, and 126 days later was up 46%. So my point in bringing that up is not to try to predict what's going to happen, because nobody knows. The market is very unpredictable. What I wanted to do is just illustrate the fact that just because the market has gone down so much so fast does not necessarily mean that it will continue to go down. In fact, I missed that. On average, 126 days later, the market was up 10% and the median was up 8.4%. Once again, there's quite a broad range. There's some plus, some minus, but on average, the average and the median, 63 and 126 days later, was positive. That was, counting depressions, recessions, the financial crisis, all these different things incorporated. On average, 2 months and 4 months later, the market was up. I don't know if that's going to happen this time, but it just goes to show you that you cannot necessarily extrapolate, okay, we've gone down this much, it's going to continue to go down. The one thing, should investors make changes to their portfolio? People get tired of hearing this, to stay the course or things like that. The reason for that is not people should be adjusting your portfolio. You grow older, your goals change, you have kids leave home, kids go to college, kids get out of college, you need new cars, you need a new home. A parent is getting older, a parent dies, life changes, you lose a job, you get a new job, life changes, and so you should be looking at your investment policy on a regular basis, and you should change it when those circumstances change. When I say stay the course, it means that in the middle of one of the worst declines on record yesterday is not when you should try to be making these decisions. It's the same thing we tell widows is if your husband passes away, the next day don't make big financial decisions. You don't have the clarity of thinking. Well, it's the same thing. When you're in the midst of something, you got the TV on and everything, don't at that point make these critical decisions. Well, we're coming off break. We'll continue with the discussion when we come back on the other side. For All Things Money, I'm your host, David Blain.